Hello friends, welcome back. The covered call is a guaranteed return strategy. It requires us to own the asset. The asset can be stocks or ETFs if you are doing the covered call with indices. All these details we have seen in the previous videos. The capital required for covered call is somewhere between 5 to 10 lakhs depending on the asset that you choose. Can we do the covered call with less capital without owning an asset? Yes, it is possible using the future. In this video, I am going to explain about the covered call with futures, the capital required, why we should do, why we should not do, and also I will try to cover the scenarios using the Nifty as an example. To get a clear idea, do watch this video till the end. If you are new to the covered call or covered call with indices, there are videos for you to watch. The links are given in the description below. To set the right context, let me do a very quick recap of the covered call. In this strategy, you buy a stock or an asset equivalent to one lot and go and sell the call option at the money or slightly out of the money. The collected premium from the sold call option is the guaranteed return. This strategy works very well when the asset is in bullish mode or mildly bullish mode or even during the sideways mode. When asset falls, your rental income will go down and you have an option to keep the asset as long as you want, expecting it to recover. To own the asset, as I mentioned, is somewhere between 5 to 10 lakhs depending on the stock or the asset that you choose. And the margin required to sell one call option varies between 1 lakh to 2 lakh, again based on the asset that you choose. Half of the margin that is required to sell a call option can be utilized by pledging the asset that you own as a collateral. Coming to the covered call with the future, here we go long in the future and sell a call option at the money or slightly out of the money. This works exactly like a covered call using the stock or any other asset, except that the future has the expiration period. The collected premium here also is the guaranteed return. There is no initial investment or the cash that is required to buy any asset or the stocks. The margin required here is for the future long, it is 1 to 2 lakhs. For selling a call option, it is 1 to 1.8 lakhs depending on the asset that you choose. Both put together, the total margin required to initiate this strategy is 2 to 4 lakhs. Friends, this is almost half of the capital that is required compared to the covered call with the asset or the stocks. It looks very attractive. Let us try and understand the various scenarios and then see what are the implications. Let me use Nifty as an instrument and try to create a covered call with Nifty future and a call option. I am going to use Sensible as the tool because it will be easy for you to understand with all the scenarios. To create this strategy in the Sensible tool, you will have to go to Strategy Builder, click on that. A strategy builder will come. You see the default instrument that is selected is Nifty. If you want, you can change. Let me go back to Nifty and click on the build a new custom strategy. First, I have to go long on the future. So let me select future. The nearest monthly expiry future is 26th May. I am going to buy one lot of Nifty future and the current price is 16,681. So let me go back to option chain. I have selected the monthly expiry for this option chain. What is the nearest ATM strike to 16,681? That is 16,700. So let me sell a call option at 16,700 and collect 299 as the premium. That is the premium that is available now. So press on the done button. You can see both the legs, the future, long and sold call option. On the right side, there is a payoff graph. The total collected premium is 299. The amount is 14,950. Right side is the payoff graph and all the details. The margin required is 1.07 lakhs. That is because upside is fully protected. Because of the margin benefit, only one side margin is considered, which comes out to be approximately 1.07 lakhs. The maximum profit is 15,900 and the break even is 16,681 minus 299, which comes out to be 16,382. That's the break even. In the first scenario, when Nifty expires 16,700 100 or above anywhere, you will make a profit of 15,900. Upside it is completely protected. The maximum profit is also capped at 15,900. You can see this payoff graph. See here 15,900 on the upside anywhere the Nifty goes and expires. As I mentioned, the break even is at 16,382. After which if Nifty falls, you will start making a loss. Depending on where it expires, you can see the black box and also the loss that will be incurred depending on where it expires. If you have not done any adjustment or if you have not locked the max loss, then you will have to incur this loss in the future. Of course, you can do the rollover, etc. That is possible, but again it depends on how you want to handle the future. So the main difference between the covered call with future and covered call with asset is that when the asset or the future falls, in case of future, it definitely requires an attention and an adjustment. In case of covered call with an asset, of course you can do the adjustment, but you have an option to keep the asset as long as you want, expecting it to recover. Here are the advantages and the disadvantages of the covered call with the future. You will get all those advantages that you would get from the normal covered call using the asset, except that the future has the expiration period versus the asset that can be kept as long as you want. Another main advantage of this strategy is the capital required is less compared to the normal covered call with the asset. Friends, the high reward comes with the high risk. The fall in the future definitely needs an adjustment. If it is not adjusted or not properly managed, you may incur a loss in the future. Especially the gap downs and all will put you in trouble. Another important thing to note is that the MTM loss in the future is cash settled on daily basis. For example, if the future is showing minus 40k loss on a particular day, minus 40k will be taken out from your account in the next following day. This is going to impact your margin requirement in the account. The fall in the future is going to test your psychology. This strategy definitely needs more monitoring than the covered call with the asset. A quick conclusion on this strategy. Friends, the less capital requirement should not be the only reason to consider the covered call with future. You need to consider various other factors before initiating the strategy. As I mentioned, this strategy works very well when the market or the stock is in bullish, mildly bullish or sideways mode. You need to be good in taking this right view before initiating the strategy. In case if your view goes wrong, the future will start falling, then you need to be ready to adjust the strategy. I have explained 3 types of covered call, 2 of them in the previous videos. The first one is the covered call with the stocks, second one is the covered call with indices using the ETFs. Third one is the covered call with the future is what we discussed in this video. Friends, based on your need and the assessment, you can pick the best suitable strategy for you. But don't forget to consider the factors like the level of skill, the amount of time that you have, and the amount of capital that you have, and the psychology for your assessment. I hope you learned something out of this video. Do consider pressing the like button and also subscribing to this channel if you have not yet. Please leave your feedback, comments, or any clarifications in the comment section below. Thank you for watching. See you soon.